Have you ever wondered about your mortgage, that 30-year loan you're paying every month, or the car loan that gets you to work every day? Where did all that money, hundreds of thousands of dollars or euros, actually come from? The usual answer might be, from other people's savings that the bank keeps. Sounds reasonable, right? But what if I told you that more than 90% of the money that exists in our economy, the money you use to make those payments, buy your coffee, or support your family, was never actually printed? It doesn't come from any vault or cash reserve. In reality, most of the world's money is created at the very moment you sign a loan agreement, with a single click, not by governments, but by commercial banks. Sounds like a conspiracy theory, doesn't it? A system where money is born from debt and disappears when that debt is repaid. A system where, for money to exist, someone must always be in debt. So, what is money really? Who has the power to create it? And the most important question of all, why do we, the working people, feel like we're running on an endless hamster wheel? We work harder and are more productive than the generations before us, yet financial freedom seems further and further away. In this video, we're not going to talk about quick ways to get rich. We're going to do something much more important. Read the instruction manual of the operating system called money, to understand the rules of a game that all of us are forced to play, from the day we're born until the day we die. Money. What is it, really? If you asked your grandparents, they might tell you about a time when money had real value. A single dollar could be exchanged for a fixed amount of silver. Money was a certificate, a piece of paper that represented something tangible and precious sitting in a vault. It had a solid anchor. But that anchor was cut loose. The turning point came on the 15th of August, 1971. United States President Richard Nixon announced the end of the direct convertibility of the United States dollar into gold. The event, known as the Nixon shock, changed the rules of the global financial game forever. Since then, we've entered the era of fiat money. The word fiat comes from Latin, meaning "let it be so" or "by decree." Today, money has value not because it's backed by gold, silver, or any physical asset, but simply because the government says it does, and more importantly, because we all collectively believe it does. In other words, money has transformed from a kind of hardware gold into a kind of software. It's a collective belief system, a giant ledger that runs on trust. The value of that $100 bill in your wallet doesn't come from the paper or the ink, but from the shared belief that tomorrow you'll still be able to use it to buy $100 worth of goods and services. Understanding this is the first step toward realizing that we're playing a completely different game than the generations before us. Who creates money? Most of us picture a massive government mint, where crisp new dollars or euros roll off the printing press. It's an iconic image, but one that hides the truth. The amount of physical money, cash and coins, makes up only a tiny fraction, roughly 3 to 8% of the total money supply in the economy. So where does the other 90% come from? The answer lies within the commercial banks you interact with every day, and it's created through the process of lending. Imagine you take out a $500,000 loan to buy a house. The bank doesn't walk into a vault and pull out $500,000 from someone else's savings account to hand to you. No. They do something much simpler. When your loan is approved, the banker types a few numbers into a computer system, and instantly, $500,000 appears in your account as a digital balance. Boom! A completely new amount of money has just been created out of nothing. At the same time, another entry is recorded, a debt of $500,000 in your name. That new money then goes to the seller, who deposits it into their own bank account, and the cycle continues as it circulates through the economy. And the reverse also happens. Every time you repay part of your principal, say $1,000, that $1,000 is deleted from the system. It doesn't go into anyone's pocket, it simply vanishes from the balance sheet. Here's the shocking truth. Nearly every dollar or euro you hold in your hand or see in your account began as someone's debt, somewhere in the system. The debt loop, why we can't escape it. Once you understand that money is created from debt, a troubling logical consequence appears. If every dollar in circulation corresponds to a debt, then what would happen if everyone in the world, individuals, businesses, and governments, decided to pay off all their debts at once? The answer is simple. There would be no money left. The economy would completely collapse. Our system doesn't just allow debt to exist, it requires it. Debt must constantly grow for the system to keep functioning. There always have to be new borrowers, new loans being created to replace the old ones that are repaid, and to generate new money to fuel economic growth. Then comes the issue of interest. When a bank creates a $500,000 loan, it only creates the principal, not the interest you'll have to pay back. So where does the money to pay that interest come from? It must come from the overall money supply, which itself is created from other people's debts. It's like a giant game of musical chairs. There's always more debt than money to repay it. That forces everyone to keep competing and working just to stay afloat. It's why inflation feels built into the system, and why growth isn't optional. It's necessary to keep it from collapsing. This is the hamster wheel, the feeling of having to keep running forward just to avoid falling behind. Central banks, the hidden conductors of the monetary system. If commercial banks are the musicians that create money, then who's the conductor? That role belongs to the central banks, institutions like the United States Federal Reserve or the European Central Bank. They don't directly create most of the money that people use in their daily lives. Instead, they control the orchestra through one powerful instrument: interest rates. Think of interest rates as a valve that regulates the flow of credit. When a central bank lowers interest rates, borrowing becomes cheaper. This encourages individuals and businesses to take out more loans. Commercial banks, in turn, create more money, and the economy speeds up. Conversely, when central banks raise rates to fight inflation, as we've seen recently, borrowing becomes more expensive. People borrow less and repay more of their existing loans. The creation of new money slows down, and some money effectively disappears as old debts are paid off. The economy cools down. By adjusting this valve, central banks can speed up or slow down the entire economy. Decisions made in Washington or Frankfurt can affect your mortgage rate, your job, and the prices of nearly everything you buy. They are, quite literally, the ones conducting the rhythm of the game. The illusion of value. So, if money is no longer backed by gold, and if it's created through debt, what truly gives it value? The answer, once again, is trust. Money is a social contract. It's a story we all collectively agree to tell each other. The story that says, this piece of paper, this number on a screen, has value. As long as everyone believes in that story, the system works. But when that trust begins to waver, the story starts to crack. We've seen it happen during periods of hyperinflation, when money became worthless. We saw a lighter version of it during the 2008 financial crisis, when trust in the banking system collapsed. And we're feeling it again today as inflation quietly erodes the purchasing power of the money we work so hard to earn. Money, at its core, is one of humanity's greatest collective illusions. It's neither good nor evil. It's simply a tool built upon something invisible yet powerful, our shared belief. What can we do? At this point, you might feel a bit overwhelmed, maybe even frustrated. It's as if we've all been playing a rigged game. But the purpose of understanding all this isn't to become cynical or to chase conspiracy theories. The goal is to equip yourself with knowledge. You can't change the global monetary system overnight, but once you understand the rules of the game, you can start playing it more intelligently. You begin to realize that saving cash over the long term actually means losing money, because inflation isn't a flaw of the system, it's a feature of it. You understand that debt isn't always bad. There's good debt, the kind used to buy assets that generate income, and bad debt, the kind used purely for consumption. You learn to use debt as a tool, instead of letting it control you. And you start exploring real assets, things with intrinsic value that don't rely entirely on collective belief, real estate, shares of good companies, or even newer forms of assets. Understanding money won't make you rich overnight, but it will give you something far more valuable: clarity. It helps you escape the cycle of fear and confusion around finances. It turns you from a passive player into an active one. Money itself is not the ultimate goal. Freedom is. And understanding how money truly works is the first and most important step toward that freedom. If you found this video helpful, don't forget to leave a like and hit subscribe so you won't miss the next ones.